Well, today we're going to break down everything it means to own a home and hopefully help you with your next home be a little more confident in the purchase and the whole process. So, my name is Todd Uzzell. I'm a mortgage loan officer. Been at it for about 10 years, and I help people buy their dream home or their next home, or any real estate property they might want to own. So let's get into it. So what is a mortgage? A mortgage is a loan from a lender to help you buy a home. There's a lot of reasons why you would take a loan. If you had cash in the bank, you might not. But at the end of the day, it's just a collateral loan like any other car loan, land loan. A pawn shop, I guess, would be the smallest version of it. But yeah, it's just a collateral. You are saying, I want to borrow money for something. You're going to own it while I pay you off, and when I'm done paying you off, I will own it. So that's essentially how purchasing a home works. You could think of it as renting money from the bank, but again, that's any kind of financing. You're using their money for a time for a hopefully flat interest rate. Maybe not. Sometimes there's other moving interest rates or ARMs or things like that. But most home loans these days are 30-year fixed flat interest rates. So let's talk about what's in a mortgage payment. You have your principal, your interest, your taxes, your mortgage insurance, and your homeowner's insurance. Those are often just wrapped into insurance. You probably heard the term PITI, principal, interest, taxes, insurance. Well, that's what all of those stand for. So let's say, for example, you're buying a $400,000 home in Phoenix, Arizona, and principal and interest would probably be, say, $2,500, give or take, assuming somewhere in the 7% range for a loan. Then you have your escrows, which your escrows are essentially a bucket that you keep your taxes and your insurance in. Your mortgage insurance doesn't go in your escrow bucket. That just gets paid every month, and we'll talk about that in a minute, is kind of why that exists, why it's important, why it's good, why it's bad. So your escrow bucket is sometimes called prepaids. When you buy your home, there's a list of closing costs and all the costs that you have to pay to consummate the loan. And your escrows are normally about a year of your homeowner's insurance and 3 to 6 months of property taxes, depending where you live. In Arizona, it's normally about 3 because we collect taxes every 6 months. So your servicer, the person that you're going to make your final payments to, your monthly payments to, is going to hold that money in an escrow bucket or an escrow account. And every time your homeowner's insurance comes due every year, they'll pay it. And every time your taxes come due, they'll pay it. And that's kind of a double protection. It's a protection for the bank to make sure that the home insurance is paid. So if your house burns down, then we can replace it. And obviously, since the bank owns that your house as a collateral, you want to make sure they can replace it if something goes bad. So they want to make sure that homeowners insurance is covered, and property taxes same way. If the property taxes don't get paid, at some point the county or the state is going to call those taxes due and sell your tax debt or tax lien in a foreclosure. So in order to avoid that, we have an escrow bucket. There are times when you can waive escrows. If you put up to 20% down, a lot of lenders will allow you to waive escrows and pay them on your own. But again, that's a little more risky for the bank. They don't love that. Still, could be an option depending on the type of loan and the bank you're working with. So let's talk about down payments. For different loan types, there are different down payments. For USDA, VA, down payment assistance loans, you're not going to have a down payment. Those, I consider them all 100% financing. A down payment assistance loan wouldn't technically be considered 100% financing because the down payment assistance program is covering your minimum required down payment for the FHA loan or the conventional loan or what have you. But at the end of the day, the only thing you're going to be responsible for coming in with is closing costs, more or less. And depending on the market and the seller, there's a potential that the seller could cover those closing costs. So in a down payment assistance product or USDA or VA loan, there's a potential to come in with very little out of pocket. So that's enticing depending on what the financial situation is, or if you just are trying to conserve as much cash as possible. Minimum down payment for FHA is 3.5%. Minimum for conventional is 3%. And there are benefits to all loans, obviously. An FHA loan is really designed for that first-time home buyer that may or may not have great credit. With an FHA loan, you can start as low as 580 on your credit, keeping in mind that mortgage credit versus consumer credit isn't always the same. So, if you're looking at your Credit Karma or your, Capital One is sending you your credit score every month, that's going to be considered consumer credit and probably uses a different algorithm than mortgage companies use. For now, all mortgage companies across the board use the FICO 2 scoring model, which is kind of old, but at the end of the day, it takes a longer look at your history. So if you had a, collection or a missed T-Mobile bill 3 years ago, that might still be chasing you and keeping your score a little lower on a mortgage credit report versus a consumer credit, where generally those are looked at a little more short term, so they just don't care. You might have 700 credit on Credit Karma with your consumer credit and 650 on a mortgage credit report. So those are just things to think about. We always take a look and try to maximize your credit score before it's time to purchase your home. So those are things that we discuss in our initial conversation. Reasons to put more down or less down. FHA, there's not a lot of reasons to put more than the minimum down. There's an argument to put 10% down potentially, to where over the life of the loan of those first 10 or 11 years you could get rid of that mortgage insurance. But recently the required monthly mortgage insurance for FHA was reduced a couple years ago, so it makes it less punitive. And depending on what market you're in, like I'm in Arizona, so our market tends to appreciate pretty quickly. So to me, putting as little as you are comfortable with down and letting the market kind of build the equity in your home is a pretty good strategy. But for the conventional loan side, minimum 3% down. The downside to putting 3% down is you're going to pay the highest percentage of mortgage insurance for a conventional loan with a 3% down payment. Now if you move up to 5%, that rate goes down, and you go to 10%, it goes down a little more, and then 15%, and then of course at 20% you don't have any mortgage insurance. But if you're considering, say you have excellent credit, 720 plus, your mortgage insurance percentage is going to be low. For example, on that $400,000 house, say you have $80,000 and you want to put $80,000 down to avoid paying mortgage insurance. Well, mortgage insurance on a 10% down conversation there would probably be about $100 a month, and reducing that down payment 10% would add another, let's see, say $300 a month. So call it, your total payment would be $400 a month higher, but you'd be saving 40 grand at the beginning. So you just have to decide if 40 grand is worth 400 bucks a month, and for how long. Because the likelihood is you're going to refinance sometime in the next 2 to 4 years, and that's just market driven. If your home is appreciating 3 to 5% a year, and you sit on it for 4 years and you're making your payments on time, all that stuff, you're probably going to be in a 20% equity position into that third or fourth year anyway. So keeping that 40 grand, maybe investing it with your financial advisor, making 8 to 10% on that might make better sense than putting it into your home. So everybody's financial situation is different, but those are just kind of conversations we have and ways to think about how to use your money as it pertains to real estate. Maybe you're going to want to buy an investment home in the future, so that down payment will be more necessary for an investment home, because investment homes tend to require a larger down payment. PMI is not evil. It is a tool, and the beauty of it is it allows us to not put 20% down. I think it really started becoming popular in the 80s, because prior to that, if you talk to your grandparents or anybody that bought a house probably pre-90s, they were bringing 20% down, and that was the model, that was the understanding, that you had to save your 20% down. And so now, like I said, we can do down payment assistance, we can do 3% down, 3.5% down, so the barrier to entry to purchasing a home is much lower than it has ever been in the past. So that's really the benefit to the concept of mortgage insurance. You're essentially paying the bank just in case you default. And again, as your home appreciates in value and you get closer to that 20% equity position, then you can refinance or recast, or there's a few things you can do with your loan to reduce or remove that mortgage insurance. So it's a tool like all other financial tools, and I think there's a good reason to use it. And it at the very least will keep you from having to put 20% down if you have other places to put that money. So that's kind of home buying in a box. I know there's a lot more to it, and everyone's situation is different. If you just need a place to live, then we try to get you in as cheap as possible. If you want to buy a duplex or try to become an investor, then there's a plan for that. So these are all things we talk about in our initial and continuing conversations, and the goal is just to get you what you want, get you into the home. If it's a home of your dreams, great. If it's a stepping stone to the home of your dreams, that all makes sense too. But yeah, we want to get you what you want and help you make it as seamless and painless along the way. So I hope this was helpful. My name is Todd Uzzell. I'm a mortgage loan officer. And if you have any questions, please put them in the comments. Shoot me a text. I'd love to talk to you. Have a great day.